setting stops. Serious traders place stops the moment they enter a trade. As time passes, stops need to be adjusted to reduce the amount of money at risk and to protect a bigger chunk of profit. Stops should be moved only one way, in the direction of the trade. We all like to hope that a trade will succeed, and a stop is a piece of reality that prevents traders from hanging on to empty hope. When you are long, you may keep your stops in place or raise them, but never lower them. When you are short, you may keep your stops in place or lower them, but never raise them. Cutting extra slack to a losing trade is a loser's game. If a trade is not working out, it shows that your analysis was flawed or the market has changed. Then it is time to run fast. Serious traders use stops the way sailors use ratchets, to take out the slack in their sails. Losers who move stops away from the market vote in favor of fantasy and against reality. Learning to place stops is like learning to drive defensively. Most of us learn the same techniques and we adjust them to fit our personal styles. The following are the basic rules for placing stops. 1. Stop-loss order. Place your stop the moment you enter a trade. Trading without a stop is like walking down Fifth Avenue in Manhattan without pants on. It can be done. I have seen people do it, but it is not worth the trouble. A stop will not protect you from a bad trading system. The best it can do is slow down the damage. A stop-loss order limits your risk, even though it does not always work. Sometimes prices gap through a stop. A stop is not a perfect tool, but it is the best defensive tool we have. When you go long, place your stop below the latest minor support level. When you go short, place a stop above the latest minor resistance. The parabolic system moves the stop in the direction of the trade depending on the passage of time and changes in prices. If you use the triple screen trading system, place your stop after entering a trade at the extreme of the past 2 days' range. Avoid all trades where a logical stop would expose more than 2% of your equity. This limit includes slippage and commissions. 2. Break-even order. The first few days in a trade are the hardest. You have done your homework, found a trade, and placed an order. It has been filled, and you placed a stop-loss order. There is not much else you can do. You are like a pilot strapped into his seat for takeoff. The engines are blasting at full power, but the speed is low, and there is no room to maneuver. Just sit back and trust your system. As soon as prices start to move in your favor, move your stop to a break-even level. When the takeoff is completed, your flight is at a safer stage. Now you get to choose between keeping your money or gaining more, instead of choosing between a loss and a gain. As a rule, prices have to move away from your entry point by more than the average daily range before you move your stop to a break-even level. It takes judgment and experience to know when to do it. When you move a stop to a break-even level, you increase the risk of a whipsaw. Amateurs often kick themselves for leaving money on the table. Many amateurs allow themselves only one entry into a trade. There is nothing wrong with re-entering a trade after getting stopped out. Professionals keep trying to get in until they get a good entry, using tight money management. 3. Protect. Profit order. As prices continue to move in your favor, you have to protect your paper profits. Paper profit is real money. Treat it with the same respect as money in your wallet. Risk only a portion of it as the price of staying in the trade. If you are a conservative trader, apply the 2% rule to your paper profits. This protect profit order is a money stop, protecting your equity. Keep moving it in the direction of the trade so that no more than 2% of your growing equity is ever exposed. More aggressive traders use the 50% rule. If you follow it, half the paper profit is yours and half belongs to the market. You can mark the highest high reached in a long trade or the lowest low reached in a short trade and place your stop halfway between that point and your entry point. For example, if prices move 10 points in your favor, place a stop to protect 5 points of profit. If in doubt, use the parabolic system to help you adjust your stops. When you are not sure whether to stay in a trade or not, take profits and reevaluate the situation from the sidelines. There is nothing wrong with exiting and re-entering a trade. People think much more clearly when they have no money at risk. A trade does not end when you close out your position. You must analyze it and learn from it. Many traders throw their confirmation slips into a folder and go looking for the next trade. They miss an essential part of growing to become a professional trader: review and self-analysis. Have you identified a good trade? Which indicators were useful and which did not work? How good was your entry? Was the initial stop too far or too close? Why and by how much? Did you move your stop to a break-even level too early or too late? Were your protect profit stops too loose or too tight? Did you recognize the signals to exit a trade? What should you have done differently? What did you feel at the various stages of the trade? This analysis is an antidote against emotional trading. Ask yourself these and other questions and learn from your experiences. A cool, intelligent analysis does you more good than gloating about profits or wallowing in regrets. Start keeping a before and after notebook. Whenever you enter a position, print out the current charts. Paste them on the left page of your notebook and jot down your main reasons for buying or shorting. Write down your plan for managing the trade. When you exit, print the charts again and paste them on the right page of your notebook. Write down your reasons for exiting and list what you did right or wrong. You will have a pictorial record of your trades and thoughts. This notebook will help you learn from the past and discover blind spots in your thinking. Learn from history and profit from your experiences. This is Richard Davidson for Wiley Audio. Thank you for listening. This audiobook is a co-production of Penton Overseas and Audio Scholar, and is based upon the book entitled Trading for a Living by Dr. Alexander Elder. It is copyrighted in 1993 in the name of Dr. Alexander Elder and is available in print form from the publisher, John Wiley & Sons, Incorporated.